Now, there are a lot of videos about the top mutual funds that you can buy and hold forever. In my personal opinion, there is no mutual fund that you can buy and hold forever. Just imagine every year you see the list of the best large cap mutual funds, or the best mid cap mutual funds, or the best hybrid mutual funds, or the best flexi cap mutual funds. You look at the same magazines or the same YouTube channels and you go back to those channels next year, you'll see that there'll be new people entering the list. There'll be new fund houses entering the list. There'll be new funds entering the list. The next year, it will be a completely different list of funds. It could be a completely different list of funds the next year. So what are you expecting investors to do if you're telling them that you can buy and hold this fund forever, but every year the list is different? Are you expecting them to sell out and then buy the new fund? Or are you saying that the people who watched it in 2023, for example, can buy and hold that forever, but the people who buy in 2024 will buy and hold this new list forever? Isn't that going to make a difference? Because the first year is not going to matter if you have been investing for 100 years or 20 years or even 10 years. So what's the point of all of the content about buying and holding mutual funds forever? I feel personally that you cannot hold a mutual fund forever. And I know that, this does not seem very theoretically correct, but it's practically correct. And the reason why I'm trying to be practical is because I'm trying to build a long-term portfolio here, which I can actually hold forever. And I feel that I cannot do it with mutual funds. And this is a big change in my investment portfolio as well. Now, why are index funds easier to hold forever versus mutual funds? First of all, you don't have to make a very big decision. So for instance, if you decide to invest in Nifty 50, you have a few options. You have the Nippon India ETF, you have the ICICI ETF. There's 22 ETFs. What is the difference between those ETFs? Hardly anything. There's hardly any difference between any Nifty 50 ETF. Over the longest period of time, fund houses like Nippon India have their ETFs at a very low expense ratio. Something like Navi comes up, something like a new fund house comes up, they'll have a slightly smaller expense ratio. But that's about it. There's no fund manager difference. There's no strategic difference in the way they invest. There is no role as such of the fund manager. The algorithm remains the same. It just tracks the top 50 companies of the country. That's all the index does, which means that there is not going to be a lot of content that you will see on YouTube or in magazines and financial economic times of explaining the difference between SBI and UTI and Nifty 50 and why SBI is 100 times better than Nippon India or anything like that, because there's not going to be a lot of change and hence they're not going to attract a lot of audience to that content. It's very important because this is going to play games with your mind. Once you've invested in mutual funds, you're going to have games being played in your mind by media houses or YouTube channels about what's the next best mutual fund. And you'll end up owning tens of mutual funds. And that's the problem, because after some time, you will find 10 new ones which are much better, which are the best for 2025, which are the best for 2035. There'll be a completely different list of funds in 2035 from how I see this industry moving. I've been investing for the past 10 years, and there's probably going to be a lot more ETF investors and index investors is what I feel. So when I say ETF or index, it means the same thing. It's just different instruments. But my idea is that you don't have to worry about the fund manager because the fund manager does not play a major role. So fund managers don't change. Every few years, you will see the fund manager of this fund house has changed. Should you still continue your SIP or should you stop your SIP? Any news or any article that's asking you to stop your SIP, you have to stay away from that kind of investing strategy, because the moment you stop your SIP or you sell your investments, that's the time you lose money. You only lose money when you sell, because you lose compounding, you pay taxes, and you don't stick to your investments for the longest period of time. In my personal opinion, the only funds that you can buy and hold forever are index funds. And I have actually picked up and made a watch list of 5 funds. The reason I actually made this watch list is because I was helping a friend make a portfolio. Again, I'm not a certified personal finance consultant, so don't take this advice and directly implement it. You have to do your own research. This is just what I saved on my list. Okay. So the ICICI Prudential Nifty 50 Index Fund, I think, is a very solid fund, low expense ratio. ICICI Prudential Nifty Next 50 Index Fund, very solid fund, long-term, low expense ratio. It's not going to change. After 5 years, after 10 years, after 15 years, 20 years, maybe there's a huge boom of index investing in India, a little bit of expense ratios goes here and there. It's always going to invest in the top 50 companies. This fund is always going to invest in the next 50 companies. The portfolio allocation is always going to be based on the market cap of the companies. It's going to be auto-adjusted. So things that don't change are the things that will get you long-term results. That's my mantra. And because that's my mantra, I would say the only things you can buy and hold forever are things that change less, because you can get rid of the market noise and you can stay invested for the longest period of time. Now, for the mid-cap 150, I would say Nippon India, Nifty Mid-Cap 150 Index, super good, low tracking error, low expense ratio. Nippon India Nifty Small Cap 250 Index Fund, very good fund. Now, again, someone might come in and say Nippon India ka small cap fund is giving better results than the index, which I also, invested in small cap actively managed funds. And I would not say that they are wrong, but can they be right for 5 years, 10 years, 20 years, 25 years, 30 years? That's the question that we need to ask. Because if someone else then comes and says that, SBI small cap fund has beaten Nippon India small cap fund in 2024, then you will get distracted. You will want to try that fund. And that's what happens with me as well. I'm not perfect and I've made a lot of mistakes in my portfolio as well. In fact, I made a video on this about the top mistakes that I made. And I said that my portfolio is basically compounding off my mistakes, right? But if I were to start afresh, I think these would be the 4 funds. And I would probably add a 5th one for the NASDAQ 100 exposure with probably Motilal Oswal NASDAQ 100 fund. I mean, these are things that I know will be true in the longest period of time to work, right? If I have to be even slightly safer, I would get rid of probably the small cap one, and I would keep Nifty 50, Next 50, and Mid Cap 150. If I have to be safer than that, I would keep a Nifty 50 and a Nifty Next 50. If I have to be really safe, I would just focus on building a business, making money, and keep putting that money in the Nifty 50 index. That's about it. It could be any index. Again, these are not sponsored videos. No one is sponsoring me for making these videos. None of these fund houses have paid me anything. So I would say any index fund is going to be as good as a fund to buy and hold forever. That's my take on the top funds that you can buy and hold forever. And in my list, it's all index funds. I don't believe that you can buy and hold a mutual fund forever unless you forget about it, right? And that has happened with people's families. They've forgotten about mutual funds. I also know a friend whose, their grandparents, I think, forgot about the fund, and now the fund house doesn't exist anymore, so they're trying to get the money back. That could happen with index funds as well. I'm not saying they are perfect, but at the same time, the distraction of the market noise, the change of these fund managers, the change of the strategy, especially if you're getting a flexi-cap fund or it seems to be like the YouTube favorite. The government regulations can change about flexi-cap funds that invest in the international markets. The strategy could change. Suddenly a new fund manager would say, I want to try a more aggressive allocation to this kind of category. If you're doing a hybrid fund, you might face the same issues. If you're doing a sectoral fund, you might face the same issues. A lot of talk about momentum funds and, getting that alpha and all of that. I think market cycles, we will see. Right? We will see what happens over the longest period of time. There was a phase in the US where, momentum funds were all the thing. Like that was the trend. Everyone was talking about it. Now no one talks about it, right? So things change over time in different markets. Trends come and go. But I think if you have to stick with the things that will stay for the longest period of time, it's probably just going to be investing in the index. So that's my message for this video. Thanks so much for watching. I'll see you in the next one.